I think the world will return to pre-pandemic low inflation environment. The inflation break-even curve told us all the way along. Look at the 10-year, 5-year forward inflation break-even rate. It's already back to pre-pandemic lows. Even 2-year inflation break-even rate back to 2%. The bond market have spoken out. We're going back to the pre-pandemic lows.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup Larsen.
Welcome back to another conversation in our series of episodes that focuses on markets and investing from a global macro perspective. This is a series that I not only find incredibly interesting, as well as intellectually challenging, but also very important given where we are in the global economy and the geopolitical cycle. We want to dig deep into the minds of some of the most prominent experts to help us better understand what this new global macro-driven world may look like. We want to explore their perspectives on a host of game-changing issues and hopefully dig out nuances in their work through meaningful conversations. Please enjoy today's episode, hosted by Alan Dunn.
Thanks for the introduction, Niels. Today I'm joined by Chen Zhao, Chief Global Strategist at Alpine Macro. Chen's been in the markets a number of years. Prior to joining Alpine Macro, Chen was co-director of macro research at Brandywine Global Investment Management, and prior to that, he spent many years at BCA Research, where he initially wrote the China and Emerging Markets publications before becoming Chief Global Strategist and author of the flagship Global Investment Strategy publication. Chen, great to have you. How are you? How is all with you today?
Very good. Thank you for the invite. More than happy to talk about anything you want me to talk about. So.
That's great. Well, we normally start off by asking people to tell us a little bit about their experience in the markets and how they get into economics and financial markets. And obviously, you've spent many years on the research side as well as some time in investment management. So how did you initially get started in the markets?
Well, I was just sent to the United States for study by the Chinese government in the late 80s. And I was doing my PhD in economics. At the time, China was a pretty hot topic. Everybody wanted to know what's going on in the early 90s. And then at the time, there's a company called BCA Research. The chairman of that firm, Tony Beck, who is really very early on this China story. So he said, this thing is getting big, so we better be in the right place to launch some research. So he went out and find me and said, "Hey, this is well. At least at the time, I was a Chinese. That's for obvious reasons. Give it a try." So that was when I was hired in early 90s, 1992 to be precise. And then he said, why don't we just try to do a China publication? So that's when I launched BCA's first China publication. It's called the China Atlas. At the time, I think it was the earliest China-focused investment research publication in the whole world. I don't think anybody else actually had China-focused research. But anyway, that was 1992, 93, and actually I ran that publication for a couple of years. And then we had this Asian crisis in 98. And then at the time, everybody would want to understand what's going on in the emerging market. That's when I took over the task of creating a BCA's emerging market strategy. So that's when I created the BCA emerging market strategy. Basically, I wrote two publications simultaneously for a number of years. And then 2005, I became the firm's Chief Global Strategist. At the time, the company went through some kind of turmoil. Some people left, some people, but anyway, it was at the time was a bit of a chaotic. That's when I took over the global research, and I ran it for 10 years, from 2005 all the way to 2015. And then I decided that I want to try something else. So that's why I joined Branding One, which is a big global bond funds. So I was their co-head of research for 2 years. And then I decided, so that is not something that I want to do either for a long period of time. So I still love research. That's when I co-funded this Alpine Macro. Right now, I have about 40 people, well, 45, 42, 45. I lost count, but are growing pretty fast. I have a whole range of products that are already offering to the clients. So here we go. That's my story in a nutshell.
Great. Well, a lot of interesting stuff you've been involved in markets for. So we might go back over some of those interesting periods, and particularly China. I'm sure we'll get onto China later on, but the fact you were covering China in the early 90s must give you a very interesting perspective. But maybe just focusing in on the current juncture at the moment, it's been, I guess, an unusual cycle in the economy and markets, in the sense that, US rates have gone from 0 to over 5%. A lot, going back a couple of years, people didn't think they could go above maybe 2.5%. And notwithstanding all of that, growth continues to be pretty solid. Obviously, we had job numbers recently that pretty okay. The unemployment rate's still at a multi-decade low. So, I mean, what's your perspective on why the economy has been so resilient in this cycle and that rates have had to go up so much?
It's a very interesting question, an extremely important one, because if you don't understand what has gone on, you would not be able to understand what will go on in the future. So let me give you my 2 cents. We took a positive view on the U.S. equities since September last year. So lots of our clients probably know that. Right now, we're taking down our bullishness towards stocks. We're not calling for a new bear market or anything like that. I think there are few major concerns that we need to pay attention to. You just mentioned the economic resilience of the U.S. surprises most of the people. I have heard a lot of explanations. I'm telling you, none of these explanations really convinced me that they got the story right. I think I have a great story. I'm not trying to sell you anything, but I'm just saying, nobody has actually noticed one big thing happening in the United States. What is it? It's a massive fiscal expansion going on. Since July last year, I'm just giving you the magnitude. The magnitude is unbelievable. I cannot understand why nobody was talking about that, okay? Since July last year, okay, U.S. fiscal spending has gone through the roof. We're talking about 20% annualized increase, spending side, and at the same time, tax receipts collapsed by about $500 billion. So the net new fiscal thrust to the U.S. economy since the third quarter of last year was about $1.5 trillion. What is it? $1.5 trillion is about 5-6% of GDP. Come on. That is a huge number. I cannot understand why people don't talk about that. Okay? If you have a 6% of fiscal expansion, by the way, this is extraordinary in the sense that if you look at the U.S. history, most of the time, monetary policy and fiscal policy work in the same direction. We have monetary easing, usually fiscal policy also easing because of this internal stabilizer, right? You have a recession, tax collection usually going down, government spending usually going up because of welfare spending and things like that. We call that internal stabilizer. So most of the time, these two policies move together. Last time that they diverged was 2017 when Trump cut taxes, but the Fed was also raising rates. That was the first time. But hey, at the time, inflation was low, undershot, not a big deal. Okay, you cut taxes, the Fed was trying to normalize interest rate. That was the first time. This is second time, but much more consequential. The Fed is tightening at the most aggressive pace ever. And at the same time, the federal government is pumping a load of stimulus into the system. This is quite an extraordinary thing. I think that explains everything that we have gone through. What is it? Well, think about it. Why the hell stock markets just kept running at the time that interest rates are rising too? Because physical stimulus support growth and therefore stock prices. Why stock prices kept going up? Bond yields are also held high. Well, because of physical stimulus. The physical stimulus basically suppresses bond prices and supporting stocks. That's another reason that you have this weird combination of rising stock price, rising stock valuation, but also rising bond yields. That is very strange, very unusual combination, right?
Interesting. Yeah, I mean, it does seem to be something that has been missed by a lot of analysts, as you say, a kind of a significant fiscal deficit of the order of kind of 5-6% of GDP. Is that just, I guess, the typical electoral cycle in the sense that obviously we have an election coming up next year, or how do you see that evolving over time?
No, it's not really typical at all. I think the Biden administration passed 3 spending bills: the Inflation Reduction Act, CHIP Act, and the Infrastructure Acts. All these 3 bills basically were passed when the Democrats controlled the White House, the Congress, and the Senate. So basically, that was a very rare moment that they rushed through the three spending program. That's why this thing is significant. Most of the time in the post-war history, it's very rare to see very proactive fiscal policy at the time when the Fed is doing something. How I see this in going forward, I think that is a very important question. My message here is that I think right now we're at the maximum strength of this fiscal stimulus. I think most likely from next 2 to 3 months, that physical kick on the U.S. economy will begin just to diminish. When I'm saying that, these 3 spending programs, once they started, there is always a big jump in the program, in the spending, in various spending projects. But these programs are extended over the next 5 years. Actually, the whole funding process is a multi-year process. So I would say once you adjust upward your spending level, the net incremental increases will diminish and eventually dies, right? So I would say probably starting from next month or so, maybe next 2 months or so, the net stimulus is going to diminish, and then eventually it's going to go down very fast. The fiscal thrust might become fiscal drag early next year. Most part of this year, at least the first half of this year, the world was based on one theme and one theme only: U.S. recession. How possible the U.S. would not have a recession? Okay? That's everybody's view. Now, the whole world has changed. Everybody was looking at the same direction. There will be no recession. That's sort of a narrative today. Soft landing, no landing, whatever. I'm very concerned that actually at the time when everybody was looking at no landing, soft landing, you may end up with some kind of economic slump, 2024, or maybe recession. Why am I saying that? Well, the reason is fairly straightforward. Number one, because of this fiscal stimulus, the Fed policy rate was lifted way higher than they would otherwise, right? So once the fiscal stimulus dies, you're left with rates that are much higher than the economy can afford. That's when the economy might run into trouble. So that's point number one. Point number two, we all understand monetary policy work with the law of variable lags. So nobody actually bothered to measure what kind of lag we're really talking about. I use my ruler, look at all the past cycles. I'm telling you, I can give you precise lags on average. If you talk about inflation is 23 months from the date the monetary policy tightened to the date the inflation peaked, you'd usually require 23 months. For the economy, it's about call that 18 to 19 months. Okay? So in other words, right now we're into that spot when the previous rate hikes should be felt more and more acutely by the economy going forward. So you could have a perfect storm of some sort when the fiscal thrust, fiscal support is removed at the time, the rates are already left too high, and the lag impact of monetary tightening begin to filter through the economy. If you put all those things together, that's why we have turned a bit of a cautious, because we were bullish. We were comfortable to be bullish when everybody was so bearish. Right now, being bullish is just a part of the consensus. So that's why we are positioned to be very bullish on bonds. Nobody wants bonds. We're bullish on bonds. I think the bonds are going to deliver way better returns than stocks probably 2024.
The other element to the macro picture that obviously you've called correctly as being the inflation picture. You know, inflation has come down. Now, even with the low, the very promising June number, there still remains a bit of caution, around the wage growth. Just a couple of things on inflation. One, how are you so confident inflation would come down given what you saw on the fiscal side? Was that not going to be a cautionary element to the optimistic view on inflation? And two, now, do you think the consensus view now is that inflation is under control, and is that a concern, or are you still as optimistic on inflation as you were?
I think there are 2 to 3 points I think it's worth remembering. Number one, go and check the inflation, the interest rate this time around. The inflation topped out the same month as Fed started to raise interest rates. These two things happened simultaneously, which tells you what? Which tells you that this inflation so far has nothing to do with Fed. The Fed, we know that it has a lot of variable lags. Come on. The inflation already dropped before you raise rates. So it got nothing to do with you, right? You being Fed. Okay? So that's the first thing. The second thing is that if that is true, then given, as I said, if you measure a post-war period or the inflation versus monetary tightening versus inflation, the time lag is usually 22 months, 23 months. Then you would say, so far disinflation is all about these supply disruptions. The San Francisco Fed, they basically decompose inflation into two components. One is supply side driven, the other one is demand driven. Now, the supply driven inflation is completely come down, collapsed almost. Or the demand driven inflation is beginning to turn down. I would argue, as time passes by, as we're approaching to that typical time lag, inflation is going to go down because of the demand side is going to be constrained. Aside from what I just said, that fiscal support will probably diminish, and the economy is probably going to go into some kind of slump next year. As I'm saying, I'm sticking to the call that all evidence suggests that inflation could fall much faster and harder than most people anticipate. That's why I'm very bullish on bonds.
And I mean, it's interesting. Last year, a big theme was around concerns about stagflation, and not just in the markets. If you listen to policymakers, Jackson Hole, it seemed to be a big theme about, deglobalisation, all of these things, nearshoring, and that we may see structurally higher inflation over time. Hearing less about that this year, but what do you think? Were they valid concerns or not?
I don't think that's a very superficial observation, superficial understanding of economics and markets as well. So I'm saying that offshoring, deglobalization we actually had a real-time test. What was that? 2016, 2017, China, U.S., they had a trade war. Tariff basically jacked up. Remember?
Well, I mean, from an economic perspective, it's a negative inward shift in the aggregate supply curve.
Exactly, they jacked up.
But is that not a reasonable observation to make?
No.
You're dismissive of that point.
Here, important here is this. They jacked up tariff rate against each other. You know what? If you check inflation in the United States, came down. Global traded goods prices came down. 2016, 17, and 18. 3-year deflation. The U.S. inflation came down very, very quickly too. Why? 2 coping mechanisms why you had a tariff or deglobalisation. One is, of course, pass on the prices to consumers. The other one is you compromise your profits. You absorb by your profit. It's a profit or prices. So we agree that tariff does not mean that you have to basically jack up prices. You can compromise your profits. If you look at 2017, 2018, stock prices came down. Bond yields actually dropped. Bond prices actually was strong. That's my first observation. That's my second observation. Onshoring, friendly shoring, whatever you want to call that. Look at the U.S. manufacturing share of GDP. Look at the U.S. manufacturing job as share of GDP. It has no change. It's like 11.3% of GDP flatlined for the last 5, 6, 7 years. Even though you're talking about the onshoring stuff like that, it hasn't happened. It has not happened in any meaningful scale. Okay, that's not I'm saying it. I'm just watching that like hawk every day.
What about the boom in factory construction? It's up about 100 billion this year versus last year.
Well, there about more than $100 billion actually went away to somewhere else. Yeah.
But in aggregate, that's what the data is showing, that the manufacturing and construction in the manufacturing sector is up about 100 billion more than last year.
I'm just saying, I just checked manufacturing GDP as a share of U.S. GDP has been dead flat.
Yeah, I mean, I think the manufacturing output did, but this is more on the construction side.
Exactly. There's no output. There's no employment.
Yeah, I mean, I don't. This is the point I think has been made, is we're seeing the construction now, and presumably that in time will lead to the manufacturing output.
I can't check that, but I can tell you another data, which is extremely important. U.S. CapEx has been contracting by a 15% annualized rate in real term for the last 6 months. So I don't know where you get that data, but we can check, we can challenge each other. But I'm telling you, U.S.
Well, I mean, obviously you've got different components to the investment demand side. Obviously, residential construction has been weaker.
No, I'm talking about business equipment.
Yeah.
Software.
Yeah.
Yes.
Okay.
Software and equipment. I'm
talking about plants and facilities, so two different things.
I don't see the evidence of that.
No, that's fair enough.
Yeah, I don't see the evidence of that. So that's why I personally don't believe that. I mean, besides, if you look at U.S. tradable goods prices, U.S. import prices, it's falling. It is a negative number. I'm not lying. You can check that anytime. Okay. So I don't see these things has become a material impact on and in terms of affecting U.S. inflation dynamics. In the end, we're all macroeconomists. We understand one thing: inflation only comes from where? Aggregate demand is bigger than aggregate supply. That is a precondition for inflation. What is aggregate demand versus aggregate supply? In a reduced form, is there only one thing and one thing only: available saving versus your desired investment. Right? If your available saving is bigger than your desired investment, sorry, you have to deflate. That's all. That's it. That's all. I'm telling you, I don't see a sustained spurt of desired investment in the U.S. that is going.
Okay. But was that not the intention of the CHIPS Act, et cetera, to try and encourage people like Taiwan Semiconductor to build plants? I read recently that they wanted to build a plant in Arizona. They've had to delay that type of thing. Are you kind of skeptical that that's going to be a meaningful trend?
I am totally skeptical because You don't have to build that in China. You don't have to build that in countries that are no longer friendly to you. But you don't want to attract these investments back to here because it's not possible, man. The labor cost is different. The business environment is different. It's not competitive. I mean, if it's the same thing, Chinese government screw up a lot of things by the state intervention. You're using the same thing to fend off the Chinese bad practice. That's the wrong thing. It hasn't been effective. I don't see that. I think the world will return to pre-pandemic low inflation environment. The inflation break-even curve told us all the way along. Look at the 10-year, 5-year forward inflation break-even rate. It's already back to pre-pandemic lows. Even 2-year inflation break-even rate back to 2%. The bond market have spoken out. We're going back to the pre-pandemic lows.
Okay, so given that backdrop, how do you see, so obviously growth has significant headwinds next year, inflation to continue to come down. Do you think rates will go all the way back to zero, or are we in a new normal or not?
And they're basically saying that has everything to do with your judgment call on R-star, equilibrium. So the question here is the R-star, well, before the pandemic hit, we know that R-star is about a 1%, right? Plus minus at a 1%. We're talking about real.
Yeah. I think the Fed would have said maybe 0.5%.
Yeah, 0.5%. Whatever, right there. So my question, I have a simple mind. I ask simple question all the time. Say, is today's R-star lower or higher than pre-pandemic? Real.
Yeah.
I think it's going to be lower. The reason for that is very simple. Economic growth, steady state, consists of two things and two things only. Labor productivity growth plus labor force growth. That's two things give you a steady state real growth. Now, for the United States, labor productivity growth is always steady, about 1.5%. Sometimes it's 2%, sometimes it's 1.5%. About last decade or so, it's about always 1.5%. So let's take that as your steady state. Your labor force, man, U.S. labor force is being way lag behind. We have a 0%. We have a 0% population growth, close to 0% labor force growth. If you look at the labor, actually, the gap between GDP and what is required for the labor force to grow, there's about don't quote me, about 5 million people short relative to where the economy is. So if you take that into consideration, you tell me whether your steady state growth will be higher or lower. I think it could be lower just from the labor force growth point of view. They can resolve that problem easily to import a lot of people. I'm not sure that is a popular thing in the U.S. today. So everybody, both candidates do not seem to be pro-immigrant or pro-immigration. So I think, you have to basically take it as a given that U.S. labor force steady state growth rate is probably plus minus 0%, around there. So if that is the case, then you basically down about 0.5 point in terms of steady state growth rate. How possibly will R-star be higher if your steady state growth rate be lower than pre-pandemic? I don't get it.
Okay. Well, I guess the other point that people make around this is, and I saw Larry Summers talking to Olivia Blanchard around this. They were dating this kind of R versus G kind of equation. And Summers was of the view that R-star might be higher over time. I think it was partially around the higher investment demand. Deglobalisation was part of it. But the other question would be, other element to it is the greening of the global economy, and that there will have to be a higher investment just to produce the same level of output that we're used to. Is that a valid observation?
Well, Larry Summers, he was the author of Secular Stagnation. Come on. He was the big promoter of negative equilibrium real rate in order to equilibrate aggregate demand and aggregate supply. His thesis is that you got to build New York, you have to rebuild LaGuardia Airport is embarrassing because you have to spend because you got too much excessive saving. That was the story all the way to 2020. So I don't know what has changed his mind except that bond yields are right now higher. Okay. But the point here is this. For us to have sustained high investment growth, think about productivity. All these years, if you calculate the capital efficiency frontier, this is basically going steady, very steady, just like that, almost like 45 degrees. Meaning what? Basically meaning for the same amount of incremental output, increasingly less amount of capital is required because of technology change. That basically is saying, for a given society, as technology progresses, your ability to absorb your savings is getting less and less because you don't need that much capital investment to generate same output growth. That's called technology, right? I don't think that changed quite a bit. I mean, I think if anything, probably we're going to see accelerated technology change.
But in relation to, changing to more climate-friendly type of production, does that, do we have to change all the global infrastructure, et cetera? Is that not a one-off kind of surge of investment that might be required?
That is the risk, the green side of the thing, because there is a lot of government subsidies involved. That there is a lot of inefficiency involved. That is a risk. But I think by and large, the Chinese are probably going to walk away from the green restriction. U.S. basically, if Trump get back to the White House, he's going to toss that out the window in no time. So I think that's a risk. I agree with that. But I think, by and large, as society getting the aging process continues, people need to save more to afford longer working life, right? And also the technology change is such that your capital efficiency frontier is just getting too high, and you don't need much capital to generate all these outputs. I just keep thinking about Alpine Macro. What is our capital investment? It's just a bunch of computers, and then that's a human being, and then that which started off the ground and start to run again. So what kind of capital you need?
So this is the explanation of why we've seen this sustained kind of decline over time in bond yields. And you think that resumes kind of after this tightening cycle?
I think after this extraordinary disruption of the pandemic, it's almost like a war, right? So when you have a pandemic, you shut down the economy. It's no different from having a war. You shut down your big chunk of your supply, got an inflation spurt, and the whole thing basically back to normal. So that's what I'm thinking. We're probably going to move back.
Okay. The other point that people raise as part of this debate then, on the kind of the multi-decade inflation outlook is China. And obviously you're very well placed to speak about China. And I guess the view being that China was a, disinflationary force, when they came into WTO, et cetera. And then within China, the demographic is changing there, that China may cease being that kind of disinflationary force. So what's your...
China is no longer a disinflation force. It is a deflationary force now. So the China problem is there are two sides of the problem. Of course, I think it's demographic stuff is completely overrated. I just keep telling people, hey, China used to have a much bigger population, but the same size of the economy. Now, India basically outgrow China by population. Now, India has a bigger population, but Chinese economy is 5 times bigger. So yes, India has won the population race, but lost in the economy 5 times versus about the same time, right? So that we're talking about early 90s. So India is about what? 500 million people. China about 800 million people. Now it's the same. At the time, the Chinese economy was about what, 30% bigger. Now 5 times bigger. But anyway, it doesn't matter. So the Chinese problem got two issues. One is macro issue. The other one is a micro issue. Micro issue, in my view, is a much bigger issue. Why I'm saying that is basically it's because of Xi Jinping. Xi Jinping is a populist leader, has no clear economic philosophy in his policy. He just moving back and around, back and forth. He talked about all thing, everything. Nobody understands what the hell he was talking about, to be honest. That's why the private business basically have lost confidence in him. Nobody want to invest. Everybody needs to think about it. If you don't know what he is really up to, why on earth is anybody, using your own money to invest in that economy? Nobody wanted that. That's why lots of private entrepreneurs, they're trying to get out. So that is a much more fundamental, much more serious problem than the macro. The macro problem here is that the Chinese government is basically scared by its own shadow. What is it? Because we in the West told them that they cannot build up their debt too much. If you don't build up their debt too much, you're going to look for trouble. So don't lever up. So they don't. If they don't lever up, then you got an over-saving problem that is so severe that actually prices go down. That's a classic example of saving far exceed the desired investment. So then the only adjustment process that can happen is your price decline or your output decline or both. Right now, I can tell the Chinese price, I just look at major measures of Chinese CPI actually is beginning to fall. So they need to drop that debt argument, just go for a spending spree or actually subsidize consumer spending. Give consumer a spending coupon with expiry date. Why not? Each household give you $10,000. You have to spend the money, otherwise it expires by the end of this year. Why don't we do that? They're just not imaginative. He is a bad policymaker, period.
Mm. So how do you see that playing out? I mean, obviously we've got the real estate deleveraging, and
we'll have deflation in China.
Yeah, and so is like from a macro trading investing perspective, how would you play that?
Bullish on bonds. I think the Chinese local currency bonds probably going to be 1% yields a year. Why not?
And in terms of the currency, what's the impact on that?
I think the currency probably they don't like the currency to be at this level. Of course, they want the currency to be a little bit weaker, but right now they're also very mindful of all hostilities that is around China. They don't want to piss off too many people, too many countries. But I think there is no question in my mind that if you have a deflation, the way out is to get your currency down.
So putting all that together, obviously the picture you're painting is very much inflation, very much under control, economic challenges as we head into...
Yeah, the biggest surprise now, going forward, when everybody was so bullish and positive, I think the big surprise is that the growth actually could surprise us on the downside, especially the U.S. fiscal side is withdrawn. Rates are already lifted at a restrictive level. And you can see that most of the time in the past couple of decades, we can always count on China to reflate and to bail out the rest of the world in terms of growth. So this time around, it's not happening. So all of those basically saying there will be a period where bonds is going to rally pretty fast.
So, I mean, looking at bonds, you touched on it a little bit earlier. Have you been surprised at that yields haven't gone up more in the sense that we've had this strong inversion of the yield curve, or is that just the market forward looking towards the recession?
I think this is all explained by the fiscal expansion. If you have a fiscal expansion, the Fed will have to be hawkish to offset the fiscal side. That's why, from the monetary point of view, you have a short end of the curve probably be lifted or being sustained at higher than would otherwise be. That's sustained at a level that would be higher than would otherwise be. So that's how I see this. But there is no other fancy explanation except that your public sector is adding growth.
Yeah, and obviously we've had the Fitch downgrade recently, which most people see as a bit of a sideshow. But at the same time, there is a concern about maybe rising issuance levels. As you mentioned, the US is already running a strong budget deficit at a time of full employment. I mean, are you concerned about the debt dynamics in the US?
No, I think the US debt is all denominated in the US dollar. They never borrow in foreign currencies. If you believe the treasury paper is not as good as US dollar bill, which is the liability from the Federal Reserve, then the Treasury might run into problem. But they are the same quality in my view. The dollar bill versus the 3 months T-bill or 10-year bond T-bill, the same thing. So meaning their balance sheet is interchangeable. Why you worry about something that is not going to happen?
Okay. And obviously you've been in markets many decades. I mean, in the past, we have seen episodes like that where US debt and deficit levels were a concern and the bond vigilantes were the enforcers. That doesn't seem to be the case of late. Is that a thing of the past, do you think?
The last thing happened that the so-called bond vigilante came into play was 1993. Bond yield backed up about 100 basis points or so. I think 130 basis points, something like that. But that was a very different era. At the time, there was no communication from the Fed. Nobody know what the Fed wanted to do. And then they came out and then just shocked the market. Everybody was in panic. Here, everybody was, the Fed communicated everything. I think it's over-communicated already. So everybody knows their intention. So that kind of episode is very difficult to repeat anymore. And then August 11th, 2011, that was S&P 500. I'm sorry, that was Standard & Poor's downgrade the U.S. Treasury, same thing. The bond market spiked up about 3 days, bond yields. And then a month later, yield made new lows, all-time lows. So this type of thing, I think the market figured that out a long time ago. There's zero default risk from the U.S. government. So why bother? That's why I don't understand what Fitch is doing.
Yeah. So, from that perspective, obviously you're quite bullish on bonds here now. Do you see kind of yields presumably have already peaked? Do you think we're at kind of multi-year highs and peak? Do you think yields will be heading back towards?
I think we saw the highs last week, probably with a 10-year Treasury, 420 something, 423. Can't remember exactly. I think we probably saw the highs for this cycle. My model basically is saying the equilibrium yields is probably 2.8, 2.7, around there. So we're almost 2 sigma overshoot the fair value.
And fair value as of today, yeah.
As of today, yes.
Okay. And looking at the situation in Europe, obviously, you've had a slightly different dynamic there. You haven't had this. Okay, you've had pockets of fiscal support, but in aggregate, nothing of the order that we've seen in the US. How do you see the growth and inflation dynamics playing out in Europe?
Well, actually, in some of the countries, the fiscal support is quite substantial. Actually, you think about UK, all those subsidies to energy bills and the gas, especially in some of continental Europe. So these are not a chump change. It explains things. But I think the long and short of the story there is, I personally don't think the Eurozone faces a serious inflation problem at all. You can see the growth rate is already gravitate towards zero now. And then I look at Eurozone wage growth, especially the expected wage increases, basically come down, way down already. So it's an energy issue, in my view. And of course, there is also an element of labor market being reasonably strong too, for some odd reasons. I think I also lump that into fiscal support probably, because otherwise the Eurozone labor market would have been weaker than now. So I would say I don't see a serious inflation. Core inflation coming off pretty quickly too in across Europe. So I see very similar dynamics playing out because Europe as a whole really does not have a lot of endogenous growth momentum. Is really leverage on either China for some countries and the US for the others. So I think if these two big engines start to run into problem, I can't see that Eurozone is going to be a shining star. It's hard to create a picture like that.
Okay, so a similar kind of scenario, probably the ECB.
Yeah.
And
Yeah. I think the German bonds are going to be interesting. German bonds, I think, is going to be a good buy. I'm telling you. And then the sell-off, the relative sell-off is bigger than the U.S.
And I mean, obviously, there's a cyclical bull case. And then, I mean, beyond that, it sounds like you see the world going back to similar to the 2010s. Is that a low inflation, low growth?
Yeah, I think we're pre-pandemic. I think the world is basically going to go back to 2018, 19 type of situation. Primarily because I don't see anything that really fundamentally changed, except that there is a hostility between China and the U.S. Yes, that's true. But that also erupted during that period of time. The fundamental judgment call has to be on saving versus desired investment. Well, on Earth, the developed world, where the population gravitate towards zero to negative growth, all of a sudden you have a very strong desired investment that is popping up. I just cannot see that happen because don't forget, population growth of a nation is your natural aggregate demand growth. If your population growth gravitate towards zero, your natural demand growth will gravitate towards zero. Think about Japan. Japan has investment. It's basically replacement investment. You just make sure that your capital stock is not completely obsolete.
And from a political perspective and, the spending side, obviously you touched on if Trump got in maybe in the next election, anything in relation to green spending would be thrown out. But maybe if it's Biden or a Democrat again, I mean, do you not think globally there's this shift now, having had the experience of COVID where governments wrote checks, and as you say now, we're doing it on an ongoing basis. Is that not more the norm these days, that we're going to generally see more spending?
The best we can hope is gridlock in the United States. Gridlock is always good. Government can't do anything, just economy run its own. I think most likely it will be a gridlock. I mean, either of them get elected, it would be a disaster to me. Even Democrats, I mean, does he run the thing or somebody else runs it? I don't know. He's half steep, half weak. I don't know. Trump is even crazier. So I don't know why the Americans have to choose between these two. So I'll just stop it right here.
Okay. I mean, we've touched on how you've been in the markets a long time. You started off, Asian financial crisis. You've seen .com, global financial crisis, European debt crisis, COVID. We've had a lot of crises over time. You're painting a picture of things looking pretty rosy. We're back to 2018, 2019 again. I mean, what are the things you would be concerned about from a kind of a global risks perspective?
Actually, if we go back to the pre-pandemic world, that was not very rosy because you take some deflationary shock to knock the world economy back to pre-pandemic inflation level. Because right now, the level is still high. It's still there.
But I mean, 2019, you had generally low unemployment and low inflation.
Yeah, there's the world is low inflation is not necessarily a good thing, to be honest. As you can see that 2019, 2018, there was a lot of a pricing power issue. That's when the inflation actually under shock for the whole last decade. We got a repeated QE. That was also last decade, right? So it was not a beautiful decade anyway. But I think if you talk about risk factor, there are lots of risks. As I said, that you might have a recession 2024. You might. And then when everybody was hunky-dory, no problem, boom, you had some kind of a shock right here. That's one possibility. Another possibility is that this monetary, I look at the quantitative tightening that is still going on right now. 2018, that QT caused a problem. Remember that our market went down about 15% or so, and then he being Jerome Powell basically chickened out eventually. Right? Remember that? So we might have that kind of situation too. And to mention, geopolitically speaking, there are a whole bunch of the world is arguably way worse than 5-6 years ago. Today, I mean, everybody's, the China-U.S., that is the biggest story in town. I mean, two biggest economies in the world that are basically trying to disengage from each other. That cannot be good news. So I don't know what exactly to be the shock, but I can see a lot of problems.
Yeah. And that China-US disengagement, I mean, do you see that as having meaningful economic impacts, or do you see them as those impacts as being deflationary? Is that it?
So it has already slashed China's economic growth by no small amount, in my view. So far, that's a very reasonable assumption, because China is a producer, America is a consumer. When your customer pissed off, usually it is a supplier that actually take the heat, right? So China is a supplier. So that's why when American pissed off, the supplier get a haircut. So that's why I was saying their economy you can already see that it's happening.
Yeah. The one country we haven't really delved into is Japan, and we've seen a little bit of a change there in terms of yield curve control. Do you think that's it in terms of policy adjustments from the BOJ, and how do you see, from a JGB and yen perspective, things playing out?
I think the YCC should be eliminated, because remember that their original purpose of the YCC, introducing YCC, was to invert the curve, to steepen the curve in order to help the banks. But right now, you don't need to do that anymore. The whole world law and the curves all backed up, and then Japan is the only country that got a positive yield curve. Why the hell you still need that distortion? Actually become a symbolic YCC. So if I were to run central bank, I would get rid of it. But in terms of investment game, I think Japanese banks looks great, because the curve is inverting. They are minting profits. They have done well. I think we'll continue to do well as long as the curve stays inverted. I don't see why not. So Japan has no inflation, zero inflation problem. Japan's inflation is entirely come from foreign exchange rate. If you look at the breakdown of Japan's inflation, very complete opposites to what we have here in North America or Europe. It's entirely driven by goods inflation. Service inflation is dead. It tells me that is completely currency phenomenon. So as the yen stabilizes at this level, Japanese inflation can go back to zero again.
And in terms of emerging markets, obviously you kind of started off in emerging markets, and we've, I suppose a lot of people have been making a bullish case for emerging markets, but it's been a pretty flat period for a number of years. How do you see it going forward?
I think you got to be careful now for China, because, you cannot use the usual analytical tool to think about China anymore, because you got a geopolitical problem going on here. God knows what kind of a restriction you're going to be dealing with. I mean, Americans are trying to restrict outward investment to China, So there are lots of regulatory risk that is on the horizon. So I don't think it is a pure economic, monetary policy, financial market issue. It is a political issue, it's a geopolitical issue. So for that, I think you have to be a little bit careful. But if it's just pure economics, I would probably start to think about buying some Chinese shares, because they are just as a giveaway. Okay, it's already become a giveaway 4 to 5 times. For a big platform company, why not? But I don't know what kind of regulatory stick that the U.S. is going to swing at you if you bought it. We don't know. So, but I think the emerging market for other countries, I mean, LATAM looks really good. I really like LATAM's bond market. Like Mexican bonds, 9% inflation is 5.7, no brainer. Brazil, 11% bond yields, inflation 7.5, 7.6%, around there, depending on which measure you're looking at. No brainer. Currency is stable, so I would invest in those bond markets.
Obviously, that's consistent with your Treasury's view as well, but is that kind of on a multi-year view as well? Do you think things are structurally improving there?
12 months to 2 years. I mean, inflation. These countries, the bond yields are extraordinarily high. Just think about real yield.
Conscious that we're just coming up against time here, and we normally just ask our guests before we wrap up. You've been in the markets a long time. For people who are starting off in markets, what would any advice in terms of things to read, things to do, anything that have been big influences on you in your career over the years?
This is forever a learning process. I mean, I feel like I still learn. I'm learning, but I think one thing that I learned, and I still remember, I still keep that in mind all the time. You always ask yourself, what is the most difficult trade today? Do the most difficult trade, that is usually the right one. That actually guided us to be bullish since last September or 1 month earlier. What was the most difficult trade? Today, I ask myself, what is the most difficult trade today? Nobody wanted. So you know the answer.
Yeah, long thinking, I guess is what you're saying, yes. Okay. Well, that's interesting. I mean, it's definitely, I've heard that before, in macro trading, it shouldn't feel comfortable. So I guess...
If you feel comfortable, you're not going to make money. That's a guarantee.
Okay, well, listen, thank you very much. This has been a great conversation, Chen. Thank you very much for doing this today. So to all our listeners, make sure you follow Chen Zhao's work because as you can tell from today's conversation, he's got a lot of great insights and we're living in a truly global macro-driven world, so more than ever to stay well informed. So from all of us here at Top Traders Unplugged, thanks for tuning in and we'll be back soon with more content. Thank you.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.